Hi all, welcome back. Today we'll see one of the interesting concepts in options, in derivative structures, in both CFA and FRM, option strategies, which is nothing but the covered call. So covered call is one of the strategies used in options, predominantly used across the markets, across regions. So for any option strategies, we need two legs. Either this legs can be purely from the options front. I mean to say it can be a long call or a long put, or it can be a long call or a short call, or long put or short put. N number of combinations can be made out of it. Particularly for this strategy, the combination is very specific. That is, we are owning an underlying. Say for example, uh, we have an Apple stock. We have bought it for 30, and we have predominant investment in it. Say we have $3 million in it, but our analysis based on our intuition, we feel that the stock price is not going to uh, move beyond 35. There is no significant up move in the near term. So since we are owning a huge amount of monetary value in that, say 3 million owns a very cost of funds. It's a high cost of funds. I mean to say the interest cost in it. So you need some compensation for that. So this strategy predominantly helps that case. So this is used for income generation. This is not used for any directional moves, because uh, when the stock is, say, if we are wrong, the stock is going to move to 30 to 60, we are not going to make the $30, the difference between the purchase price and the current market price. So this strategy will be very helpful if the stock is stuck in a zone. Say for example, if the stock as we expected is between 30 to 35, yes, we'll generate an income. So how we are going to generate the income? So these are all the two graphs. I would say this is graph A, which is nothing but the long stock payoff. It's a very simple payoff. Everyone will understand this. So we have bought the stock at 30. So once it moves to 40, we make $10. I'm assuming 1 as the quantity. 30 to 40, the difference is 10. We make $10 out of it. 40 to 50, $10. Our purchase price is 30. So the 50 minus 30 is the $20. So we are making profits when the stock moves high. So that's why the payoff is linear. In the same way, vice versa, when the stock falls to 20, we lose 10. When the stock falls to 10, we lose 20. So this payoff is very linear. So we are feeling we need to generate income because we own a large quantity of stock, lot of investments into it. So somehow we need to generate income for a shorter time period. So what we are going to do is uh, we are uh, we are going to the Nasdaq, and we are finding the stock, or whether the stock is trading in option segment. Yes, it is trading. So we are going to choose a strike price of 30. 30 is the strike price. Our spot price is also 30, and the premium of the call option is $5. So what we are going to do is we are going to short this call option. We are going to short this call option. What does mean is, so even though we are going to short the call option, in this case we are the seller, so we will be collecting this premium from the buyer. So what is the obligation we have to the buyer? So even though the stock moves to 60 or 70, we'll be still selling this stock to him at 30. So that's the risk. So it's a very predominant risk. You can see if the stock goes to 60, we have to still sell it at 30. So the difference is $30. This will be your loss. Of course, fortunately, we have collected a premium of 5. So we'll be sitting in a loss of 25. So if you look at only the short call perspective, this is the case. So but in our actual case, we have owned the underlying too. So if the stock is moving up, we are going to make profits from the stock, and so whatever loss we are going to make on the short call position, that will be compensated from the long stock position. So that's the reason. So as I said earlier, I will repeat it again. We are going to our profit is very limited in this strategy. The reason is it's for income generation for a shorter time period of time. So that's the reason we have shorted this call. So if the stock is staying at 30 itself for a month or so, we'll be collecting the premium of 5. So that's where you can see our profit is capped to 5. Once the stock moves beyond to 40, since we have shorted the call, we are ending up in trouble. That means we are sitting up in loss. We need to pay to the buyer the difference if it is a mark to market condition. So this is the combined payoff. So if you own the stock and if you're shorting the call option, this will be the combined payoff. We can see it here. So once the stock, even though the stock goes to 35, since you have collected the premium, our profit is capped to $5. Our profit is capped to $5. $5. The reason is we have collected the premium of 5. Since the stock is also 30, our profit is capped to 5. So whenever the stock falls down, we are going to make the unlimited loss on it. The reason is we are owning the stock, still it goes to zero. Since we have collected only a small amount of premium, we are in a position to lose the entire capital. So that's the reason. So to repeat it once again, so the covered call is predominantly used in income generation. So we are going to make profits only if the stock is stuck in a range. I mean to say, if the stock is between the strike price, the premium amount, then we are safe, and our profits are limited to the premium received plus the stock move. Say for example, our strike which we have shorted is 30 and the premium which we have collected is 5. So if the stock goes to 35, so we'll be making $5 on the stock and $5 on the call option, because we have righted that option. The difference is 10. So our maximum profit in this strategy is limited to 10, and our profits are capped to 10, and our losses are unlimited till the stock goes to 0. So covered call is predominantly used by the people like fund managers. I mean to say, most of the funds have restrictions on the derivatives trading, but for an individual retail participants who are owning a large chunk of stock and is not expecting any direction in the immediate move, but since its cost of fund is high, he needs to generate some income. So this strategy is predominantly helpful. So hope it helps. Thanks for watching. Please post in comment if you have any observations. Thank you.